Welcome everybody to the BAM Multifamily Growth and Income Fund 4 official webinar, Introduction to the Fund, what we're seeing here at BAM Capital in terms of the market in 2023 and where we see this fund going. So we wanted to introduce to you these two folks, Tony and Ben, and I'd like you guys to maybe introduce a little bit about yourselves.
Me first?
Go ahead. Age before.
My name is Tony Landa. I'm the Chief Investment Officer for BAM. Oversee acquisitions, asset management, these two gentlemen in the IR team next to me, and also marketing. Been in real estate for a really long time. I kind of consider myself a one-trick pony in that regard. Been in the industry in a number of different roles for more than 28 years.
Ben?
So, Ben Cotton, I direct the efforts of the investor relations team. I've been in this business for about 6 years, raising, depending on whose numbers you use, $500 to $650 million in equity and debt. Before that, I spent time in automotive. I directed the efforts of one of the largest glass manufacturers in the world, their automotive division.
Thank you very much. So, BAM Multifamily Growth and Income Fund 4, high level, let's talk about that strategy for a bit and what we're looking to do here.
Yep, so we'll get into the details. I like to kind of go high level before we do. So the strategy is 2000 vintage and newer, 200 to 400 units, great location, great property, essentially a place where any of us would live if we moved to a new town. Tony, from an acquisitions, what are we seeing in the market? How many properties do you think we'll buy? What's the amount that you would think it would be? 20 million, 50 million, 60 million, whatever. Maybe get into that. How many properties and what do you think that'll be?
I think with a $150 million equity fund, which is our goal, we'll be able to buy 6 to 8 assets over a 12 to 18 month time frame. Leverage up that $150 million in equity with debt, we'll probably have buying power of roughly $500 million. And the assets, if you don't mind, I'm going to speak about the assets that we're looking for. We're looking for, it's really our bread and butter, and it's our core business, we understand it well. Looking for institutional quality assets. So what's that mean? Class A and B in what I would call superior locations in the Midwest. Quality schools, great visibility, easy access to the major economic drivers, and retail is always a plus. Our second strategy really is to identify assets that provide cash flow, our investors cash flow stability, capital preservation, and long-term appreciation potential. And we look for assets where we can use our vertically integrated platform to create operating efficiencies and economies of scale with other assets that we locate nearby. We find this to be the major value driver in something very important that BAM Capital brings to the table. And we also look to eliminate single asset risk by putting together a portfolio of these properties for our investors.
I think that makes a lot of sense. Couple of questions just so we can clarify. So when you say economic drivers, what are the economic drivers?
Fortune 500 companies.
Okay, so good access to good jobs.
Good jobs, high net worth, high white collar, but mainly white collar jobs, Fortune 500 companies. And we've been very fortunate to execute that strategy here locally in Indianapolis and some of the best suburbs.
Okay. Yeah, speaking of that, BAM Capital has transacted over $1 billion in apartment communities. Where are some of the locations that we currently serve investors?
Sure. I mean, obviously here in the Indianapolis MSA, it's our backyard. We understand it. We know the assets. We know the suburbs. We know exactly what we're getting into. Des Moines is another market where we're currently in. I think we now have 5 assets there, over 1,200 units. Love that market. We're also in Dayton, Ohio, and we're also in Illinois, specifically Champaign.
Okay. When you say Des Moines or Indianapolis, and just so we can clarify, because we all know it, and I'm sure some of our investors do too, real estate is literally can be street specific, right? So when we say Indianapolis or Des Moines, are we talking like downtown or are we talking more the suburbs?
No, more in the suburbs. We like the quality school systems that the suburbs provide. We look for assets where there's more 2-bedroom to 3-bedroom. We really try to cater to families.
Yep.
And so we are garden style, suburban, institutional quality, We wouldn't buy an asset where we wouldn't want to live, to be quite honest. One of the big things out there is residents want to feel safe, and they want to feel comfortable, and we're buying those assets and providing a home for those families.
Yeah, no, and again, we've all talked about it before. These are places we would live. The other thing is, in some of those markets, and you probably know the data, I don't want to get too deep, but those markets have been underdeveloped. So typically there's some expensive houses that are in the area that you're competing with, which is great, right? And there hasn't been as much, like the downtown Indianapolis, there's been quite a few properties that have sprung up. So are we seeing it like we talk about like an imbalance between the amount of demand versus supply?
So in any market that we go in, Des Moines, Indianapolis, I'll use Indianapolis as an example.
Yeah.
Yardi Matrix just put out a report. Year-over-year rent growth as of late 2022 was 11.6% for Indianapolis. That was one of the top 5 markets in the entire country. And what's more important about that is that people talk about oversupply. In some of our markets today, Phoenix, Las Vegas, you're seeing oversupply in a lot of those markets. The good thing about Indianapolis and Des Moines, I'm going to use Indianapolis as an example. The new deliveries in 2022 relative to the total inventory for apartments was 1.3%. One of the lowest percentages in the entire nation.
So Fund 4 is a $150 million equity fund that we expect to raise and deploy into 6 to 8 communities over the next 12 to 18 months. To put that into perspective, Fund 3, we closed at $81 million in equity. Now this is roughly double that size, and I wanted to throw the question out there why we felt confident in this sort of environment to raise the equity amount to $150 million.
Yeah, so Fund 3 was 5 assets, 82 million. This will be 150 million, 6 to 8 assets. A couple of things are going on, and Tony, jump in if you think I've got this wrong. But one, with interest rates increasing, we're seeing our competitors essentially sitting on their hands, less likely to buy. 2, if you're an owner of a current asset and maybe you've levered it up, right? You've got a lot of loans on that now. Those are resetting. Are you going to refinance it? Maybe not. Maybe you're going to sell. So we think, right, there could be more sellers, less buyers, and because of that, we're building a bigger fund. We're opportunistic. We're going to look in the markets that we're in, and if we've got the opportunity to buy when others don't want to, I think that's an opportunity.
No, I agree with you. You hit the nail on the head. There are less buyers out there, particularly in the institutional capital world. There's a lot of fear because of interest rates and a recession. So buyers are paralyzed at the moment. Some, not all. Multifamily has always been the darling of real estate, and it will continue to be the darling of real estate. So you might not see a whole lot of activity today, through the broker network. I know in the fourth quarter 2022 it was off slightly, but we're starting to see more opportunities pick up. We're starting to see less buyers at the table, although there will still be buyers. There's going to be less buyers, and we find that this is the perfect time to acquire property. And I'm also going to add too is that because we're a credible buyer and we bring certainty to close to every transaction, we are seeing more opportunities as most, and more off-market opportunities than actually brokered opportunities.
Yeah, I think translated, we get the call when it's like this thing needs to sell and maybe we don't want to market it.
Exactly.
I got it.
What do the higher interest rates do to our loan to value, or how much debt we're able to put on these properties?
Good question.
No, a lot of assets today and a lot of acquisitions or even refinances, it's the loan to value is going to be less. I mean, we're sizing deals every day through agency, Freddie, Fannie, HUD, and our local relationship here with Merchants Capital. And so we know what's going on in the market, and a lot of these deals that we're seeing, our debt service coverage is constrained. And so they can only lend you so much. Most lenders underwrite to a 1.25, we call it DSCR. And so that's usually translating into a value, at least the things that we're seeing, right around 65%, give or take a few percentage points.
All right, so not everybody that listens to this and sees this is as knowledgeable as Tony. So let's just unpack a couple of things, make sure we've got it right. So when you say it's debt service coverage limited, you're essentially saying the banks are only so comfortable with the amount of money the property brings in to be able to pay its mortgage, essentially. Do I have that right?
Correct. So if a property produces $125,000 in net operating income,
Right.
the lender is not going to give you a loan amount Well, they're going to give you a loan amount that equates to $100,000 in debt service.
Right.
So $125,000 in NOI divided by the debt service is 1.25.
Well, so the exciting part for me and Andrew is this idea that, look, there's a lot of opportunity out there. And because of that, we're almost doubling the size of the fund. Right?
Yeah.
Okay, good deal.
It may require more equity, which is fine.
Sure.
We have that investor base in order to place that equity.
Mm-hmm.
Now, in terms of the acquisitions team, you're speaking about a lot of opportunities popping up. About how many deals does your acquisitions team look at before they put an offer or before we end up acquiring a property?
You gotta turn over a lot of rocks to get that one opportunity, and we do that. We're pretty disciplined in our approach. We probably see, I'm going back last year, going for 2022, we probably see about 200 deals a month, and this is across the country, right? And it's Class A assets, it's Class B assets, it's Class C assets. We even see land and development opportunities. But 200, and we probably underwrite, I'd say 10 deals a month and put it through the underwriting process. And we probably make 1 to 2 offers every month on a deal. And like I said, we're very disciplined in our approach. We have very strict acquisition criteria, and we've got to turn over a lot of rocks in order to get that great opportunity.
We've gone into a little bit about the acquisitions, the markets that we like. What is it exactly about the Midwest that is so desirable?
There's a lot of compelling components and characteristics to the Midwest. Number one, I think it's the supply and demand imbalance. The Midwest is not oversupplied like some other Sun Belt markets or even Western markets. Number two, it's very stable, and investors like that. The volatility is very low here in the Midwest. The year-over-year rent growth is solid. Here in Indianapolis and Des Moines, Michigan, Ohio, very, very, very steady. It doesn't peak like certain markets or the higher growth markets, and it doesn't fall like some of the other markets. It's very, very steady. It's like compare it like the tortoise and the hare, right? Slow and steady wins the race. Great market for cash yields. It's one of the top markets for cash yields because cap rates are generally a little bit higher here in secondary markets. It also is you could acquire assets here at a very attractive investment basis relative to replacement cost. And I will say, because of a lot of these things, that it's attracted the interest, more so in the last 5 years, it's attracted the interest of institutional capital and private equity, more so than it has done historically.
And I would say from the development side, and you can correct me if I'm wrong, it's attracted capital, it's attracted development capital, but a lot of it's been in the downtown areas, which is, again, the reason we kind of aim more for the suburbs.
Yeah, and the population growth in Indianapolis and even Des Moines and some other Midwest markets has been remarkable. We have a deal under contract right now within a 1 mile radius. Since 2010, the population's grown by 191%. And so we like that. Couple that population growth with the low supply, and you've got a recipe for success.
Yeah, I would call that a non-negotiable, right? The population growth in the criteria.
Yep, and job growth as well. Yep.
That's a lot of great organic growth that we've spoken about, where these emerging markets are having a lot of good trends going for them. Can we jump over to the operations side and really hammer down how we get in on the operations and increase the value of the properties that way?
Yeah, I think maybe the question you're asking, and our investors ask, I mean, we hear it, is, what separates BAM? Why is BAM, better at this business than others? And it really, you don't want to be cliche, but people and culture is what separates BAM, I think, far and away. And for investors, like, how do you quantify that? So people genuinely like to work for BAM. Tony, you've been in this business a long time. Would you say the property management side of the business, do you run into a lot of folks who enjoy working at the properties on a daily basis?
No, and it's one of the main reasons why our turnover is lower than the industry average. People enjoy coming to work with BAM. They're not only doing it for themselves, they're doing it for the person that sits next to them.
Yeah, I as somebody who's new to the team, last 6-7 months, it's honestly, it's what attracted me to come work at BAM. Had opportunities to do work at other places, and the idea that it's a people-based organization. And as somebody, and Tony, you can probably, again, know it better than even Andrew and I, the secret to being good at this business isn't a secret at all. It's the operations side of the business.
No question. So I've been in acquisitions for a long time. Like I said, I've held a lot of different roles in real estate. But if I'm an acquisitions guy, I can get the greatest deal out there. If I buy a 10 cap, it's a great deal, right? But if I don't have the right people on the ground, that great deal is doomed.
Yeah.
It's just doomed. It's that simple. The people on the ground in our operations side and our operations team are the single most important department, I believe, in this company.
No, agreed. We all like to think that we're the most important, but the reality is that's not true.
Definitely not. That's my family.
All right, so competitive advantage number one is certainly the company culture and the people. Advantage number two is what we like to call vertically integrated. And so, that can mean a lot of different things to people, but maybe, are there any examples or anything you could share with us how BAM's vertical, how we do things maybe a little bit differently than some of the other folks in the business? I don't know, case study something.
Yeah, we have specific deals. I won't name the names, but some of our recent acquisitions, our due diligence process is exhaustive. I mean, we put a lot of time into pouring through the detail, making sure we're getting what we think we're getting. And so even I'll give you an example. One of our recent acquisitions, we do lease audits on every deal that we do to make sure it reconciles to the rent roll. And we uncovered roughly $60,000 in extra revenue that we didn't anticipate because the former operator was charging month-to-month fees as late fees. Mm-hmm. That's a big delta. It's a big delta. We were also able to go in there because of our operations and our knowledge of the market and our portfolio there. We were able to trim expenses by $2,000 a door because we had so many economies of scale, and we're not running them cheap. I mean, this is how we run all of our assets in that specific area. So we had good math behind it. Day one, when you cut your expenses by $2,000, that translates over to $6.5 to $7 million in value,
right,
just by walking through the door.
Right.
And so even on the operations side, we look at all the contracts, and you could speak to this too, Ben.
Yeah.
We do everything in-house. If we don't need to outsource everything. So on a recent acquisition, we were able to cut out a fairly large contract that $125,000. Again, that's a lot. It translates to a big number in value.
Yeah, no, you make a good point, and we get the question because they've seen investors will come to us and maybe looking at other markets or reading a Wall Street Journal article or something like that, and they'll talk about rent increases, and some of our competitors, that's kind of what they tout is this idea of rent increases, and the reality is, I think it's more believable, certainly to us, if when we do the underwriting, we uncover some inefficiencies, mm-hmm. right? We look for things that they're essentially just spending too much money to run the property, right? So our model's really not based on rent increases. It's based on increasing net operating income. And as I think it's, you've probably said it, I'm sure my grandfather said it, it's a penny saved is a penny earned. But the reality is, like, if you raise rent by $1, it goes all the way through all the P&L, right? Comes down to the bottom and maybe it's 30 cents. Mm-hmm. But if you save $1, it drops right to the bottom line and that's $1 in your pocket. Mm-hmm. And so for us, this idea that we look for reducing expenses, what they call other sources of income. What are some of those, like other sources of income that we can do that's not really a rent increase?
We take a hard look at application fees, administrative fees, pet fees, lease termination fees. Right. Are you charging the correct late fees? Right. The big one too is, are they charging back for utilities like they should? Right. That's a big line item. And so
it's easy, right?
Yeah. To get to your point, our underwriting and our acquisition process isn't predicated on monster rent increases.
Right.
Things that are out of our control. We like to focus on the things that we can control. Right. Operations, ancillary income. Right. And don't get me wrong, we've seen great rental rate growth, like a number of different competitors. I mean, our lease trade outs are double digits. Right. So, but we don't rely on that in our underwriting. We really focus on what we can control.
It makes perfect sense.
And how are we able to do this all of a sudden? Some people may ask the question, why didn't the last guys think to increase all these fees or increase this income, reduce these expenses? And maybe that wasn't their core business like it is for us with the property management. Maybe we bought from an out-of-state owner, we bought from what they call a merchant builder, that they're really good at developing a good property, but management maybe isn't their core business, and that's okay.
Yeah, that probably speaks to the idea in this industry that most people that own these things, they don't run them themselves.
We've spoken a bit to the acquisitions and what we're seeing out there in terms of opportunities. Why specifically should investors be looking at the multifamily asset class at this time?
If I said it once, I've said it 1,000 times. Multifamily has always been considered the darling of real estate among investors. Why is that? Number one, it's a great hedge against inflation. Multifamily has shorter term leases, typically 12 months, unlike commercial that has longer term leases. Number two, it's a tangible asset. Investors can see it, they can touch it, and it provides cash flow stability. They like that. It also provides accelerated tax benefits through the cost segregation studies that we do for every single asset. It's a big benefit to investors. It also, investors, I want to speak to the supply and demand imbalance. That's definitely true here in the Midwest. Sure. And with the population growth that's occurring and the lack of supply, it really puts upward pressure on rents. And investors, obviously, multifamily is a great long-term investment. Capital preservation is top of mind for us.
No, it makes sense. The reality is everybody needs a place to live.
And we're also buying properties with in-place cash flows from day one.
Strong in-place cash flow, absolutely. Strong historical occupancy. We look for that cash flow right out of the gates. Investors like it. And the good thing about multifamily is if you lose a couple residents, 2 or 3 residents, it doesn't move the needle that much. Right. I've worked in commercial, and I've done commercial a lot as well, acquiring commercial and managing commercial. And if you lose a big tenant, a 30,000 square foot tenant, that changes things quickly with the value of the property and your lender.
Fund 4 is a $150 million equity fund. It's similar to previous funds in that we've broken up the series units into Series A and Series B, which are treated differently. What are some differences we've done with Fund 4 as it pertains to previous funds?
So I'll start with the good news. First off, we've reduced fees by about 50 basis points. For Series A investors, they're going to receive 9 to 11% depending on what they invest. We've moved it essentially higher in the capital stack. Series A, they get a priority. What does that mean? Well, we pay it like it's debt. We've never missed a payment, and we don't ever intend to miss a payment, and we pay it monthly. Series B investors, they'll receive a 7% accrued return. It's a priority to them, so that's first. Then we get caught up to 7%, and then it's split, anything above that, split 80% to investors, 20% to us.
Why did we decide to change the waterfall for Series B investors?
Yeah, no, that's a good question. Listen, if we hit a home run, meaning it's a 30, 40, 50% IRR, it's going to be super advantageous to investors. The other thing is, it's just really easy to explain. There's no reason to have multiple waterfalls. We can still make plenty of money and be very fair to investors.
Another difference that Fund 4 has is that there's tax advantages here, but in this case, we've decided to push the majority of those advantages over to Series B. Why is that?
Yeah, so B investors typically care about total return. They're not as concerned about current income. And so in exchange for that, we're giving them the tax advantages. The investors who say, look, I'm not as concerned about total return. I'm really concerned about a known number. I want to know what I'm getting paid every month. Those folks go into A. So really it's simple. We've split it into two. If you're an A investor, your concern is I want current income. If you're a B investor, you say, look, I'm okay. I'll hold on. I want the best return I can get. And I'd really like some tax advantage, like you talked about earlier. I'd like the tax advantages because I've probably got some other income that I'd like to offset.
We just launched Fund 4 in March, and we're very excited about the year ahead of us. Where are we right now in terms of acquisitions and deploying our first capital?
Good question, Andrew. I'm excited to announce that we have our first deal under contract here in Indianapolis, an excellent suburb with quality schools and excellent demographics. This specific area within a 1 mile radius grew up by 191% since 2010. Medium household income within a 1 mile radius, $140,000. Like I said, great school systems, easy accessibility to all the major economic drivers here in Indianapolis. More twos than threes, out-of-state owner, everything that we want to see in an asset. And not to mention, very strong in-place cash flow, new construction. We'll be able to preserve our investors' cash, and we're going to be able to add value through our vertically integrated platform.
No, I think that's great. And maybe I heard through some other folks on your team that maybe when we visited, nobody seemed to care about, if you were a prospective renter, they weren't coming to kind of get you to lease a place.
No, I walked it for 20 minutes and nobody greeted me. And I actually, at first I didn't think we were going to be able to get this asset or be awarded the deal. I thought, the pricing guidance was way too high. But at the end of the day, they chose BAM Capital because we're credible, because we bring certainty to close. And there are a couple groups that backed out. And I don't even know if we were the highest bidder there, so I'm very happy with this acquisition.
That's great. That's great.
That goes back also into, there's less buyers in the market right now that are bidding up these assets where we have almost never been chosen as the highest bidder. It's because of BAM's credibility and track record to close on deals.
Correct.
We just talked about the first acquisition we're excited to deploy into Fund 4 soon. Let's take a step back and look at the overall average hold time and our expected returns for Fund 4.
That makes sense. If I'm an investor, I want to know, hey, listen, what are my returns going to be and how long are you going to hold these properties? So returns. If you're if you invest in B units, you should theoretically see in a 3 to 5 year period a 2x return. They call it a MOIC, right? It's a multiple on invested capital. You should see a doubling of your income and of your invested capital in that 2 years. Is that a guarantee? Absolutely not. As far as hold time, if Fund 4 has 8 properties, right? It could be less, it could be more, it probably won't be more. But let's just say for easy math, it's 8 properties. 4 of those properties will transact within 3 to 5 years, either refinance or sell. 2 of them could be sooner, right? We work our plan, we're doing a better job, we're hitting on all cylinders. We might do 2 of them sooner. And 2 of them might take longer. And so net, it should be about a 3 to 5 year hold period.
I'd love now to dive into some of the questions we've encountered as we discuss Fund 4 with our current and prospective investors. One of those questions is, why did we decide to increase the minimum investment to $200,000?
Look, I think that's a fair question. And in some ways, it's a little bit of a tough one to answer. BAM Capital is growing up. And we've done really well for investors in individual deals, Fund 1, Fund 2, and we've returned roughly $200 million. I mean, just last month we returned another $12 million. So we've got a large number of investors. When I say large, about 800 active investors that, the right thing to do is to let them come back in first. I think they've been with us from the beginning. It's the right thing to do. And so they've got the wherewithal to do those larger amounts. The other thing is, as we grow this business, and I say we really aren't the impetus, but we do help grow it, right? We're part of that machine. We want to do it intelligently, and we'd like to do it with our existing partners and some new partners. We need new investors to come in, no question about it. But we'd like those investors to mirror what we've had in the past, which is those that come in after fund, because we've done a good job for them. We're not asking them to come in if we haven't done a good job, but the idea is we'd like to have fewer, stronger relationships than 6,000, 7,000, 10,000 investors. That's not our future.
Right, being spread out a bit too thin over time.
Yeah.
Good.
Any other questions?
Yeah. How does the capital call structure work? When I commit $250,000, how are you going to call that in?
Yeah, no, we wrestled with that for a little bit, but the idea is we wanted to minimize the amount of time that investors' money sat not doing anything, if that makes sense. They call that float. So if investors commit to us, we will call their money in the order they commit. So good example, we've got a new property. It's under LOI. We're going to need roughly $21 million.
It's under contract.
Sorry, what did I say? It's under contract for $21 million. And so if we get $21 million exactly committed, we'll call all 21 million. If we get 30 million committed, which based on our trajectory is probably very likely, the first 21 million will get deployed, and then we'll wait to call the other 9. So we'll continue to build the fund as we go, and those who commit first will be deployed first, which, you know, if you've got capital sitting on the sideline, not doing anything, it obviously makes sense. You want to get it in there. But the idea is we want to be able to put people's money to work as quickly as possible and not hold it so that it's not doing anything, if that makes sense.
How is BAM Capital navigating the current interest rate environment?
Yeah, we get that question often from investors, and we talk shop with other real estate owners as well and how they're navigating their way through it. At the end of the day, real estate is simple arithmetic. It really is. And here at BAM Capital, we look at what's called a stabilized yield on cost. It's the most important metric when evaluating real estate in my time in the industry. And what does that mean? So if I have $1 million and I'm going to buy an asset that produces $60,000 in NOI, that's a 6% cap rate. Not that attractive with today's interest rates of 5.5% to 6%. You're not getting a whole lot of positive leverage there, and I can get into that later. However, we look to take that $60,000 and get it to $80,000. So it's not a 6 cap anymore, it's an 8 cap, which is my stabilized yield. I'm comfortable there. Not only is it 200 bips greater than the current interest rate, it's 200 basis points higher than where I think where the market cap rates are today. That's all profit to me. So said another way, I can now take that $80,000, sell it at a 6 cap, generate $1.3 to $1.4 million, and when you factor in leverage, that's easily going to get you to a 2 multiple.
No, by the way, thank you for explaining that, because we get that question a lot, and it's this idea, if I hear you correctly, it's not that cap rates don't matter, but when we're buying, we're not as concerned about the cap rate going in. What we're really concerned about is how much income does that property produce today versus what we think we can do in the next 12, 24, 36 months.
Correct. And that's mostly through things that our operations team can control.
Right.
With expenses, with ancillary income, not really relying on rental rate increases.
Right.
The BAM companies, as an operator, that's one of our key differentiators when you talk about the competition.
That makes sense. Thanks for explaining that.
How does BAM Capital communicate with investors?
Oh, that's a good question. If I'm a new investor, I want to know, what are you going to send me? What are you going to tell me? So first and foremost, the first year of a fund, first year of a property, typically there's not a lot that we have to report. I mean, we could make up a bunch of stuff, but the reality is there's just not a lot to report. That being said, as we build the fund, anytime we need to add a new asset, you'll get a pretty nice supplemental that tells you all about that asset we're getting into. As far as valuations and that sort of thing, again, the first year there's not a lot to report. We do have a portal, and investors get a log into that, and they can look at their holdings and that. We'll send out some sort of letter quarterly, but again, not a lot of number-heavy stuff in the first year.
Right. So we've got that 24/7 investor portal. We will eventually get those quarterly reports out that are more detailed as time goes on. There's more data to report.
Year 2, 3.
Yeah, we have investor bulletins, those newsletters, and then our team is always happy to answer a phone call, a text, or an email.
Sure.
Is Fund 4 1031 exchange eligible?
No, that's a pretty common question. So as far as the fund itself, no, we can't take any 1031 dollars. But that being said, if you're a B unit investor, there's a considerable amount of depreciation and losses that get passed to you. So it's very likely in the first year you'll see a significant amount of losses, even if we do send distributions, which again in the first year probably not likely.
Right, so even though you can't 1031 into the fund, you can often get a similar fill by reducing your tax exposure with the losses you can generate.
Correct, and with the way we've structured the new fund, the more of the losses are going to be than they have in the past.
What are some of the different debt strategies that we deploy here at BAM Capital in this current environment?
So one of the good things about multifamily is that you have a plethora of lenders that will be willing to lend you money. Unlike commercial, that space dries up during the tough times. But for multifamily, you got Freddie, you got Fannie, you've got HUD, you've got life insurance companies, you've got regional banks, you've got local banks. And so that borrowing is not a problem. With the rising interest rates, we really look at each deal and every acquisition or refinance opportunity differently. Every deal has a different strategy. Some are shorter term strategies, some are longer term strategies. So we have plenty of options on the table. So depending on our strategy, whether it's longer term, we might look to lock rate with Freddie or Fannie. I mean, to be quite honest, and fix the rate. If it's shorter term, more of a little value add component where we have prepayment flexibility in years 2 or 3, where we either can refinance, pull our equity out, or even sell the asset, we'll go that route. During times like this, sometimes we buy rate caps. If it makes sense, and if it makes sense for the property, and it's not really, really expensive, we'll buy rate caps, which basically says your interest rate, your all-in interest rate can't go past a certain point. So you're protected in that regard. Some we don't. Again, it depends on the strategy. But we also are prudent about it. And we also have what we call owner reserves. So large sum of capital in the event that, really for interest rates. So on our balance sheet, on the property's balance sheet, we have large amounts of reserve to protect us from the current environment that we've been in. And we're constantly evaluating. Every day we look at the debt, we look at the interest rates. Everybody knows treasuries are like a yo-yo today. It's hard to keep track of, but we have a system in place monthly where we meet and go over all of our debt, go over all of our projects to make sure we're doing what's right for our investors.
This has been really great. I think that we have added a lot of value. I hope we have added value to everybody watching or listening in. Thank you so much for taking the time to go into some of the strategies that BAM Capital employs. If anybody's interested in learning more about our current offering, please go to capital.thebamcompanies.com.